As we discussed at the beginning of the analysis, global equity markets are seeing a somewhat significant divergence. The chart here shows that the Russell 1000, which will operate almost identically to the S&P 500, is actually up this year. As you can see in the other charts, the Euro stocks, which is European stocks, the Nikkei, and actually the Mexican Bolsa are all down relative to the U.S. The bottom chart, the dark line, the blue line, is the Shanghai. That's China, folks. What that's telling us is in the tariff wars, China is losing. So the years and years of China building up these massive trade surpluses with the United States, pegging their currency to our dollar to give them a trade advantage, protecting their markets by not allowing U.S. investors in, not allowing U.S. businesses to come in and do business in China without a Chinese partner. All of these restrictions, which built their economy into the powerhouse it is today, are actually now a weight around their neck as they go into this trade war with the United States. It's also important to point out here, this is not necessarily a political issue. This is a bipartisan issue on both sides where everybody acknowledges that China is not acting fairly. So there's a lot of appetite for us to try to fix this. Whether you agree with the current structure or process or not, the reality is this is long overdue, and China is not in a good position to fight this fight, and the stock markets and the bond markets are telling you that this is the case by this massive divergence between the markets. Well, what that also tells us then is there's opportunity. When price goes down, we look for value. And there's a difference between price and value. But the emerging markets are growing fast. Their earnings are growing faster than the U.S. There's real value in the emerging markets if we are active investors and we put money in the right locations. What we also know is that U.S. equities are starting to get expensive across the board. Now, there are pockets of valuation in the U.S. markets. Value stocks are very inexpensive versus growth. But broadly, as we look at this next chart, this is the Wilshire 5000. It's a very, very large stock index. And what we'll see, you have to go back to 1999 to find a time when the broad U.S. markets were this expensive. Why is that important? That was the tech bubble crash. We've said many times that this market reminds us of 1999 in the way it's structured, the leadership, the valuations, the spread between value and growth, the spread between international and U.S. It has a lot of those similar characteristics. So we're not saying the the bear market has started today, but what we are saying is this is a time to take note of valuations. We don't want to chase hot dots in a 10-year bull market that's showing that it's as high as it's been in 20 years. It's time to be smart, and it's a time to be disciplined. So in looking for value and diverging from the crowd and looking for that opportunity to find inexpensive assets around the world, this next chart shows us how the U.S. is doing versus the international markets, the MSCI EAFE. What we see on this chart is when the chart is low or near the bottom, that tells us U.S. stocks are cheap and we should go and overweight U.S. stocks. As it goes higher, it says that the value overseas is cheaper than the U.S. So in other words, the higher this chart goes, it says U.S. is doing better, valuations are expanding, and they're doing so against the international markets. So these lines in the middle, the dotted lines across the middle, the blue line is the average. The next two are 1 standard deviation differences. Statistically, that just means when it hits a 1 standard deviation, that these spreads are wide and something to pay attention to. 2 standard deviations, which is the solid green and solid orange line, are actually anomalies. They happen maybe once a generation, 20 plus years or more. And now we're going right through a 2 standard deviation spread between U.S. and international. When we see statistics like this, and we're seeing it in other places, value versus growth, small value versus small growth, international versus U.S., when we see these 2 standard deviation differences, it's a time to take action. It's saying one asset is priced very high, another asset is priced inexpensive, and as we all know, if you're truly a long-term investor and not a trader, you buy low, you sell high, and that's how you make money long term. And of course, the opposite is true. There's always danger in following the crowd. we've seen this over and over and over again, whether it was tech stocks in 1999 going into 2000, or financial stocks in 2007, 2008, or gold in 2008 going into 2009, emerging market stocks just a couple years ago. Whenever we see an asset that's a surefire winner, that people start to say, valuation doesn't matter, it's different this time, that's when we want to make sure we are cautious in approaching those assets. And this next chart shows us just how far those handful of stocks that we mentioned earlier are diverging. So the first bar shows us the NASDAQ in 1999. That's the tech stock bubble. And as you can see, very, very high PE ratios, in excess of 50. And then we look at financials in 2008, even higher than the tech bubble. But take a look at Amazon, Apple, Microsoft, Netflix, Visa. These are the can't miss stocks of the day. These are the stocks that we keep hearing are going to be successful no matter what, just like Cisco and Dell and Microsoft in 1999. So again, whether there's going to be a big crash or it's turning over as we speak permanently, that's all to be seen by the market over time. But what we do know is that the value is getting very high in these stocks, and we have to make sure we take caution. Yes, there's earnings in these stocks. Yes, they're great businesses, just as Cisco was and Microsoft was. How do we know those were great businesses? Because they're still great today. But price of a stock and greatness of a company sometimes diverge, and that's a time to take caution. So in this value dislocation, we can see, we keep talking about value versus growth. This chart shows us the actual visual difference between the two. So going back to 2006, you'll see that when the chart is high, that says growth has made a huge run, and it's a little bit more expensive versus value. When it drops way down, then value's gotten too expensive, and you should start putting more growth in the portfolio. As we can see, we're at, again, a very high level for growth stocks versus value. Back in 2008, when value was high, that was financials having their big run, and of course we know what happened. They got beat up pretty badly in the crash. Growth stocks took off from there. As we look today, value looks very cheap relative to growth. The chart is high, and actually in this little pullback, we're seeing value perform much better than growth. Now that could reverse tomorrow with a big rally, but what that signals to us is the market is telling us that there is a valuation difference, and they do see more risk in growth, because at the first sign of stress in the market, they're pulling those growth stocks back very, very quickly. So take note, take caution, and we're going to continue to put money, again, where capital is scarce, and we want to buy those inexpensive valuations. As far as emerging markets, we talked about those as well. They've gotten beat up. This next chart shows that since the beginning of the year, emerging markets are down significantly. We do think a lot of that has to do with the tariff wars. We think a lot of it has to do with currency issues around the globe, whether it's Turkey or India or it's Latin America issues. Emerging markets are down. They're down quite a bit. They're in a bear market. There is an opportunity here. Again, earnings grow quicker in the emerging markets than they do in the U.S. So we're looking for value here. Again, like we said about emerging market bonds, when you have a highly volatile asset at a steeply discounted price, it's a good idea to take advantage of that discount. The key is, again, slowly, deliberately invest over time. Don't try to catch a bottom perfectly. Just put money in, continue to invest in a disciplined fashion, and when it finally turns, that's how you make a rate of return.